Financial Advisors, and this is our financial plan for the Garcia family. I'm Julia Hopgood.
I'm Evelina Kadachuk.
And I'm Surushi Paul.
So some things we are going to go over today is your current financial settings, some key problems, creating a specific budget that caters to you, implementing an emergency fund, debt, banking system, retirement, college savings, housing, transportation, insurance and healthcare, lifestyle adjustments, Sophia's business, and a summary of all of it together.
Although your family earns a strong income of $124,000 annually, plus the additional support from Rosa, your financial challenges are not due to how much you make, but how you manage your money. Currently, your spending is driven by convenience and short-term comfort, rather than long-term priorities. Without a clear financial structure, this leads to overspending, inefficiency, and missed opportunities to ensure stability. Our goal is to shift your financial behavior so that every dollar you spend actively supports long-term financial success, not just your immediate needs. When we analyze your financial situation, a clear pattern can emerge. This issue is not about income, but about a lack of system. Miguel earns around $78,000 annually, Sophia earns around $46,000 annually with business policy, and Rosa earns around $3,000 a month. Despite this, your family has no formal budget, no emergency savings, and inconsistent bill payments, while debt continues to grow. This highlights a key point. Without structure and planning, even a high income cannot guarantee financial security.
So here are some key problems that we notice you guys have. So such as you guys have spending habits that exceed your financial priorities, and also high interest credit card debts, and you guys don't have anything for emergency savings as of right now. And for Miguel, you're not prioritizing your employer benefits such as the 401k, and you guys also have separate finances that causes you to have missed payments and also arguments. So to start off, the best way to start off is to create a budget. So we recommend that you guys approach the 50-30-20, where 50% goes to your needs such as the bills, and 30% goes to your wants, and 20% goes into your savings and debts. So this way you're able to track all of your spendings, and we also suggest that you either limit out eating to 1 to 2 times per week, or you reduce your subscriptions, but it depends on what you want to prioritize. So let's say if you want to prioritize if you want to prioritize eating out, then you would have to reduce your subscriptions, but if you want to prioritize your subscriptions and at-home comfortability, then it would have to be eating out. So we also saw that you guys want to buy Mateo a phone, and we say that if it's not necessary to not buy a phone, but if it is necessary, you could buy him a used iPhone off of eBay, which is under $1,000 and is also good for usage. And for seasonal tickets, we know that it is an emotional value to your family, but as of right now, we say to not really interact with it, as your financial state is pretty low right now, but once you are financially stable, you can get back into your seasonal tickets.
Right now, you guys have no emergency fund. This is a big financial risk because things like job loss, medical bills, or car repairs could happen, and you would have to rely on things like credit cards or loans, which will make you guys have more financial burdens in the future. Therefore, we recommend immediately setting aside an initial goal with $1,000. An idea for this is using the tax refund for $4,200 to implement that jumpstart, or using some of the $150,000 Rosa gets, but only a small portion so that she still has that money for future health needs. So we recommend to get to at least $200,000, which will be around 3 to 6 months of expenses just in case anything happens. Next, for debt, your credit card debt is one of the biggest barriers to financial progress because of the very high interest rates. We recommend using also your upcoming tax refund. If you set aside $1,000 for that initial emergency fund, you'll still have about $3,200 left, and as the total of your credit card debt is $5,650, it would take out majority of it. Then focus on paying off the remaining balances using the avalanche method, which targets the highest interest rates first. By doing this, you can realistically eliminate all credit card debt within 12 to 8 months. It's also our best interest that you guys have a good relationship with the bank and have good credit history and not have credit card debt and that kind of history.
To address this, implementing a structured banking system is very essential. We recommend either combining finances or at minimum establishing a joint account dedicated solely to the household expenses. By automating bill payments, your family can eliminate late fees, reduce financial stress, and ensure consistency. This system not only improves organization, but also creates accountability and clarity, two key components of long-term financial stress. Currently, your family is missing valuable opportunities to build long-term wealth. Miguel should contribute enough to hold his 401k to receive the full employer match, as this essentially is guaranteed return on investment. Additionally, increasing the Roth IRA contributions allows for tax-free growth over time. For Sophia, opening a SEP IRA or a solo 401k would provide a structured way to save despite her variable income. The earlier the steps are taken, the more they can benefit from the compound strength, making time your greatest financial advantage. And if you choose to not follow this plan, it is likely that you will have 70 or more years before you retire. And if you do continue with this plan, it's likely that you would retire 10 years earlier.
So for college savings, that we see that you guys don't have anything for college savings for Elena and Mateo. So we suggest that you open a 5 to 9 plans for both Elena and Mateo and start with $100 per month per child. And since Elena does have a limited time for college, if she does approach to going to college, then you can start with more than $100 per month, but that's like a great start as of right now. And this way, by the time it's time for their college, you will have more money and more money for them, like as you save for their college savings. For housing, we recommend that you renovate your basement over time and not all at the same time, because let's say you have a change that you wanted to do, and if you did all of it at the same time, you'll have to re-renovate many times and it will cost you more money. So we say you should renovate the basement gradually, and this way, if you do renovate instead of moving to a new house, you keep your 4.25% mortgage rate, which is a low rate at this economy. And if you were to move, then you would have a higher interest rate and a higher mortgage rate.
Next is transportation. Transportation is one area where you can make major financial improvements. So the first thing is possibly selling Rosa's vehicle because she rarely drives and it has low miles. Selling the car could potentially save over $600 per month plus insurance cost. We also recommend, if it is a big priority for Elena to get a car, then we recommend having a budget-friendly one or a used car that would range around 5K to 8K. And it is ideal that we recommend delaying Miguel's truck until it becomes absolutely necessary, because these changes free up significant monthly cash flow that can be used for saving and debt reduction instead. For insurance and healthcare, your current insurance setup is not cost effective. Your whole life insurance policy is expensive and provides limited coverage. We recommend switching to a term life policy which offers higher coverage at a lower cost. Sophia also currently has no life insurance, which is risky given your family's dependence on her income and child care role. We also trust increasing your liability coverage on your auto insurance to protect your family in case of emergencies and such. We understand that you haven't opened a health savings account in HSA because you believe the money would be lost if unused. However, that is actually a common misconception, as the HSA is one of the most powerful saving tools available, and if those funds are not completely used, it can be used later for future medical expenses or such. We strongly recommend opening and contributing to an HSA to prepare for healthcare costs, especially with having Rosa, who might have increasing medical needs.
Financial improvement ultimately depends on your daily habits. By making small but consistent changes such as reducing your coffee spending, limiting going out, and cutting unnecessary subscriptions, the family can significantly improve your cash flow. These significant adjustments are not just about restriction, but about intentional spending. When aligned with clear goals, even these minor changes can produce meaningful long-term results. Finally, Sophia's business bakery presents both an opportunity and a risk. At this stage, the priority should be evaluating its profitability and stabilizing income before pursuing expansion. Opening a commercial bakery prematurely could increase financial strain risk. By focusing on strengthening the current business model first, Sophia can build a sustainable foundation and it can support the future growth rather than jeopardizing your financial stability.
So a quick summary of what we went over through the presentation. We helped you guys how to build a budget and also your emergency fund, how to pay off high interest debts, and how Miguel could use his employer benefits, and how you guys can also adjust your spending habits and plan for long-term goals. Thank you.
Yeah, nice job. Question for you. What should we do first? Should we start putting money towards our emergency fund, increase our retirement savings, or pay off our debt? What should be the first thing that we do?
I recommend paying off the debt first because of the higher interest rates and how even with those interest rates, even small debts can really increase fast. So I recommend getting that first and then potentially sooner than later do all the other priorities as well.
Okay.
On the life insurance, switching from the whole to the term to save money, is there a rule of thumb on the amount of life insurance that we should have for our family?
There's not a specific rule, but since its term life is usually much cheaper and provides a higher death benefit for a set period of time, like 10, 20, or 30 years even, I feel like that is a strong place to start. And it is free and doesn't have any additional fees for withdrawing cash or doing anything like that, so that is why we recommend it the most.
Okay. And then on the HSA, you mentioned that it's a very powerful savings tool. Why is that? What makes it so powerful?
It is because it is tax-free and it grows tax-free, and then it is also really good for an aging parent like having Rosa. So it will just allow you to have a good plan and paying. It also allows you to have paying off an initial amount first, a higher amount, so then your monthly payments aren't as high.
Thank you.
So mom has about $150,000 just kind of sitting around in cash. What should we talk to her about doing with that money?
She could put into, since she is living with you guys now, so she could put some into the household expenses such as the bills or the groceries, and then we also recommend that she does have some money aside for her independence, so she gets to buy what she wants. But it's also best if she contributes to helping with the household.
Should we put all of our money in one place, even mom's? Like one account?
I wouldn't say one account because it's best that you have a joint account for things like your bills and the main payments, but also have your independent account where you get to keep track of your own money and you get to do what you want with it.
Okay.
So you've made a lot of recommendations for how we can reduce our monthly discretionary spending, and I'm wondering if you could give me kind of an overall total about what this will look like on a monthly basis with respect to expenditures, amount we're saving, amount we're reducing debt.
It should lower, we can't say a direct number as of right now, but it should lower at least 10 to 15% of what you guys are spending as of right now. But if you guys were to follow the plan as we showed you guys, you would decrease around 10 to 15% of how much you are spending right now.
Thank you.
Mhm.
Any other questions?
Oh, good.